All right, let's talk about something that's been, well, kind of nuts in the stock market lately. I'm talking about IPOs for small and medium businesses, SMEs. You've probably seen the headlines, stories of mind-blowing profits on day one. But at the same time, there are all these whispers, these warnings that something isn't quite right. Hype? Hope? Or a huge hazard? That's what we're going to figure out.
And this is the big puzzle, isn't it? Everybody knows that betting on small, unproven companies is risky business. It's like rule number one. And yet retail investors have been throwing money at these SME IPOs like it's a sure thing. It's such a strange paradox that it's even got the Reserve Bank of India raising its eyebrows.
I mean, this slide really says it all. On one hand, you have this incredible, almost lottery ticket-like promise. A stock can jump 400% the day it lists. But on the other hand, you've got market veterans, the people who've seen it all, saying that maybe 90% of these deals are manipulated. It's the ultimate tug-of-war between greed and fear.
So to really get our heads around this modern-day frenzy, we actually have to go back in time. We need to understand why this special market for small companies was even created. And the story starts with a huge problem in the economy called the missing middle. Picture this. For years and years, if you were a decent-sized small business in India, you were completely stuck. You were too small for the big stock exchanges, but you were often seen as too risky for the banks. This created this weird economy with tons of tiny little shops and a few massive corporations, but almost nothing in between. That gap? That was the missing middle.
Now, people tried to fix this. The first attempt at a stock market for these guys was way back in 1989, but it fizzled out. Nobody was really interested. They tried again in 2005, same story. It just didn't catch on. The real game changer didn't come until 2012, when the BSE and NSE launched their new SME platforms. This time, they got the rules right, and it finally became possible for smaller companies to go public.
For years, these new markets were fine, kind of quiet. And then, after the pandemic, everything changed. Boom! It wasn't just one thing, it was a perfect storm of three separate factors that came together and turned this little experiment into an absolute frenzy.
So what were these triggers? Well, first, technology. Suddenly, everyone had a trading app on their phone. It was just easy. Second, the money part became frictionless. Thanks to things like UPI, you didn't even have to send your money in to apply. It was just blocked in your account. Zero hassle. And third, you had supply. The government started giving out subsidies, so way more companies wanted to list. Demand and supply just exploded at the exact same time.
Okay, so that's the how, the mechanics. But that's only half the story, isn't it? To really understand the why, we have to look at the human side of this. The psychology, the social media hype, and that powerful, timeless dream of getting rich quick. This is where the whole mindset shifted. It stopped being about investing in the traditional sense, finding a great company to hold for years. It became a pure listing gain chase. The only question was, how much money can I make on day one? It was all about flipping the stock for a quick, massive profit, and everyone was chasing that multi-bagger dream they saw on social media.
But hold on, why would anyone throw money at a company they've literally never heard of? Well, it all came down to one word: trust. But here's the twist. They weren't trusting the company. They were trusting the merchant banker handling the IPO. In fact, if a big-name banker was involved, the IPO would get twice as many applications. People figured, hey, if they're backing it, it must be safe. They put their faith in the process, not the actual business.
And who were these investors jumping in? The data tells a really clear story. The average age of an investor dropped a lot, from 38 down to 33. This was a new, younger wave of people, maybe more comfortable with digital platforms, more influenced by online chatter, and definitely more willing to take a risk. They just poured more fuel on an already raging fire.
Okay, so we've got the retail investors flooding in, going all in. But here's the billion-dollar question. Where was the smart money? The big institutions, the mutual funds. Well, they were mostly sitting on the sidelines. Let's take a look at the hard numbers and see what they were seeing.
But first, before we get to the scary stuff, you just have to appreciate the sheer scale of this boom. The numbers are genuinely hard to wrap your head around, and they totally explain why so many people felt that fear of missing out.
I mean, just look at this. It's ridiculous. In 2024, the BSE SME IPO index shot up over 147%. A 147. For comparison, the Nifty 50, which tracks the biggest blue-chip companies, did just over 19%. When you see returns like that, you can understand the FOMO. It was magnetic.
And that hype translated into just insane demand. Get this, by financial year 2025, for every one person who actually got shares in an SME IPO, there were 245 other people who applied and got nothing. Just 2 years before that, the ratio was only 1 to 4. The floodgates had opened.
Okay, and this is where the music starts to get a little scratchy. The RBI decided to look past the spectacular opening day and see what happened next. And what they found was a very clear and very worrying pattern.
The difference is just night and day. Look at the big company IPOs. They're pretty stable after they list. Now look at the SME column. It's a total roller coaster. Big gains, sure, but also terrifying drops. And here's the kicker. After 6 months, a whole lot of these SME stocks are trading below their initial price. The party for many is over very, very quickly.
You know, when a party gets this wild, with this much risk for regular people, it's not going to go unnoticed for long. Eventually, the market regulator, SEBI, had to step in. They saw the warning signs and decided it was time to cool things down before it all fell apart.
And SEBI's moves were pretty sharp. They basically decided to make it harder to get into the party. They're doubling the minimum ticket size, pushing out the small-time gamblers. They're making sure shares are spread out among more people so small groups can't corner the stock. And most importantly, they're saying you actually have to be a profitable business to list. The goal is simple: get rid of the froth and bring some sanity back.
And this whole saga, from start to finish, just perfectly captures that classic stock market saying. Think about it. This market was born from a problem, pessimism. It grew quietly, skepticism. It matured when people saw profits, optimism. And then it died on pure, unfiltered euphoria. It's a textbook case, and as the saying goes, euphoria is almost always the final stop. So that leaves us with one final crucial question. This whole SME IPO frenzy has been one heck of a ride, no doubt, but hype never lasts forever. The regulators are already hitting the brakes, so you have to ask yourself, when the music finally stops, who's going to be left standing without a chair?